I'm Scott Rothbart. I am a co-chairperson of the Jim and Judy O'Brien Financial Markets and Economics Colloquium. Welcome to tonight's event. We want to begin by inviting Jerry Pecoraro, the editor or co-editor of the Stillman Exchange, who has prepared some videos for all of you to enjoy. Jerry?
Good evening. As Scott said, my name is Gerardo Pecoraro, and I am the managing editor of the Stillman Exchange, the first undergraduate business publication in the nation. Over the past year, the Stillman Exchange has grown by leaps and bounds. We officially launched our website, stillmanexchange.com. We expanded our publication to 20 pages, adding 4 new sections, including domestic news, international business, an editorial section, and thestreet.com, a section dedicated to contributions from Jim Cramer, host of Mad Money, and his entire team at thestreet.com. And today, we reach another milestone. Today, the Exchange explores another form of journalism, broadcast journalism. Alongside me are 2 of my fellow editors, Adam Johnson and Richard Puzlesny, who embarked on this journey with me. The road to this stage was long and at times hectic, but we made it, and I am very excited to debut our latest achievement. At this time, I'd like to call up Adam Johnson, diplomacy student, editor of our international business section, and the correspondent for our first segment.
Good evening, everyone. There have always been recessions and recoveries all throughout history in the economy. This one, not barring. And this really brings up a question: who is going to lead us as a nation? What nation will lead us out of this recent economic turmoil? Well, we at the Stillman Exchange have decided to give our take on it, and I hope you enjoy. China has always been a hot topic when it comes to global economics. The popular hypothesis being that China's always progressing industry, lumped in with its booming population, will one day make it a global economic leader. With the recent hard times in the global economy, now is China's chance to rise and show that it's willing to be the leader. Will they step up to the challenge? The answer to the question is not so clear. The last widespread recession of this scale was seen 60 years ago. It was a different world then. Most economies stood alone and lacked the integration that modern economies have today.
And as a result of the geopolitical situation, you have a group of empires, primarily the French and the British empires, but also Dutch, Portuguese empires, and so forth and so on, and of course the Soviet Union, the great outlier in the economic system. And Germany is in a state of economic collapse and inflation. These countries are unable to get together to create a common solution to their common problem.
Along with such diverse and independent economies, the world was facing a transfer away from the old norms and going to new forms of currency. More importantly, nations switched to new forms of backing their currency.
What you have are various policies set by leading nations that can govern the system, but by the time of the Great Depression, those systems had broken down. Great Britain is unable to lead. It's no longer the great economic power it was. It no longer has the gold reserves. That's largely the aftermath of World War I.
It took a major catastrophe like World War II to put governments into wartime economies and supply steady jobs for their populace. However, a great war of arms isn't what will be necessary for the turn this time around.
It is much more likely that instead of warfare, you will have the equivalent of warfare but on an economic front. You are going to see a large number of patchwork solutions with several countries leading in their own particular way without trying to sacrifice any of their own national self-interest. How do you square that circle? I'm not sure.
Many economists believe the drive out of this recession will not be a unilateral effort. However, most economists do acknowledge that some nations will contribute more than others. This is where China comes in.
There are two major ways China can help the global economic recession, particularly help American. Number one, just trying to summarize, is trying to stabilize the economy at home in China. And the second, trying to keep and borrow more American bond from the government. So those are the two ways Chinese government is going to make a major contribution.
In the present time, China's been growing by leaps and bounds, and many wonder if such a booming population is a good thing. Yes, the workforce is larger than any other, but society is seeing young couples choosing not to have kids, which translates to an aging population with no one to support them.
Since China has a large population, so they have a lot of human resources there. So that's what makes the China markets more attractive in two ways. One is if you make the products in China, the cost will be lower, and the labor cost will be much lower. Mm-hmm. So that's why a lot of consumer products nowadays is made in China. And on the other hand, since China has such a big population, they have a lot of potential.
The International Monetary Fund, otherwise known as the IMF, has sharply revised downward its forecast for world growth in 2009.
IMF projection, the economic growth in this year is going to be 0.5%. Mm-hmm. If you divide the growth rate of population, that could be in the negative category. Right now, without China's effort, it will be definitely in the negative category. Mm-hmm. If China can maintain anything close to 8%, that'd be a big, big contribution by itself.
As is seen in the numbers, China is capable of economic leadership. The next question is, are they willing? Prime Minister Wen Jiabao recently pointed fingers to the reason the times are so hard. Are Chinese governmental and business leaders willing to use the hard times as leverage to propel their economy to the next step?
Now, for the Chinese government, of course, they want to take care of their own problem first. Mm-hmm. That's exactly what they're doing.
The question of whether China can be a leader in the global economy is a heavily debated topic. They are more than capable of handling the load as a population, and the numbers point towards their ability as well. The question is whether looking out for themselves will translate to aiding the rest of the world. In such a volatile economic climate, only time will tell what will happen. China saves the world, or merely themselves.
Thank you, Adam. At this time, I would like to introduce Richard Pozlesny. Richard is a Stillman student, outside contributor at both Autospies.com and TheStreet.com, publisher of his own blog, Automotive Times, and our Stillman News editor. Rich.
Good evening. The automotive industry is going through radical change. Out are the gas guzzlers, and in are the gas sippers. Startup firms like Fisker and Tesla have begun to produce full-on electric automobiles, while powerhouses like BMW and Honda have begun to really focus on their hydrogen-powered fleet. However, the big three are left fighting for their lives, and they're struggling to preserve cash. We at the Stillman Exchange wanted to research this topic and investigate this further and see what is next for the big three.
With bailout fever taking the nation by storm, the American auto industry has been one of the hardest hit sectors. Pundits and commentators have been left questioning whether there will be a domestic auto industry in the next several months. Knowing this, the Stillman Exchange has investigated to offer its own prediction to see whether the U.S. auto industry will be back for more bailout cash in 2009.
In an unprecedented year of change, the big three automakers are facing the toughest time in their industry. Triggered by this past summer's gas price hike, there has been a shift in consumer demands and needs. Sales of America's #1 selling car, the Ford F-150 pickup truck, declined rapidly. And as we see in the U.S. annualized sales data, domestic truck sales gradually slid from February to July 2008 with a slight bump in August and September. This bump is mostly attributable to inventory being heavily discounted to make room for 2009 model year vehicles. Recent data has sales plateauing in the range of 4 to 4.5 million trucks. With this in mind, in May 2008, the Honda Civic soon became the most sold car in the United States. Clearly, it soon became evident that vehicles with less consumption were in high demand as hybrids and gas zippers became sold out. Soon, hybrids like the Toyota Prius were selling with markups over the auto's MSRP. Then, the real problem started. Total sales in the U.S. began to flounder and took a significant hit. After a gradual decline from February to May, sales tanked until they were alleviated in August and September. Like domestic trucks, this bump can be attributed to deep clearance sales, which clear inventory. In the last quarter of 2008, annualized sales remained stagnant between approximately 10 to 10.5 million vehicles. This took a significant toll on the Big Three, which saw massive demand destruction for their products. This caused a severe buildup of inventory and filled up dealer lots. Why? The American manufacturer's product mix was highly favored to large, high profit margin SUVs and did not have enough competitive small car offerings. Due to this demand destruction, the Big Three had poor sales, which translated into a significant cash burn for the latter part of 2008. For example, Ford burnt $7.7 billion in the third quarter. With demand destruction rampant and dealer lots becoming overstuffed with inventory, the Big Three scrambled to find cash. The next stop was to turn to the government for bailout funds. After 2 attempts were struck down, President Bush threw GM and Chrysler a quote-unquote lifeline of $17.4 billion, which had strict conditions, such as the firms had to reduce 2/3 of their debt and negotiate with their respective unions to cut the wages and benefits of workers. However, this is not enough. GM Chairman Rick Wagner has said that the initial $13.4 billion package received in 2008 will only last until March 2009. To get a better glimpse into what went wrong and what lies ahead for the auto industry, the Stillman Exchange spoke to TV host Matt Farah of GarageFord19.com. At first, we wanted to know why American cars are so looked down upon. This is what Matt had to say.
And it's not because we haven't figured out how to make a fast car or a world-class performance car, or a purpose-built car for that matter. A lot of the big trucks and the construction equipment and, stuff that car guys don't really think about, like giant semi-trucks, Americans make those well, and we make sports cars well too.
However, Farah did detail where the domestic manufacturers went wrong.
American cars in general really never passed the touch test. And that's something that the Germans and the Europeans and the Japanese are getting there.
Meaning that cars have to feel expensive and put together with the utmost quality. After test driving numerous cars, it becomes apparent how uncomfortable a flimsy interior can be, especially on longer drives.
When you get into an Audi, just the way the buttons feel when you touch them, the way the seat feels against your back, and the way your hands feel on the steering wheel sort of make you feel like you're driving something that's expensive. And when you get into most American cars, the ZR1 included, you sit in it, and if you're sitting still, you know immediately that you're an American car.
Clearly, the American manufacturers have a lot of work to do. But Matt Farah has a better idea of where the bailout money should have been invested.
I really think that they should invest in hydrogen infrastructure. I mean, I think hydrogen, I drove a Hydrogen 7 Series, and honestly, it felt just like a gas car. It accelerated and drove, and you refueled it exactly like you do a gas car, except with hydrogen instead of gas. And it basically cost the same to run, and you had the same kind of range, and there's zero emissions.
After hearing Matt's words, it is clear that if the U.S. government wants to make a real difference, they will take a look at the hydrogen alternative. Now, the Stillman Exchange got the chance to sit down with real money analyst David Stillman to understand where the big three are financially.
So if you really look at the three companies, Ford is still in the best shape. GM has a lot of work to do, and Chrysler is in very bad shape. GM has made about 6 press releases or industry comments, and they keep contradicting themselves. They keep saying they're seeing things get better and the lending is starting to help, and then a week later they'll say, things are just as bad as they were in December and November, then they'll contradict it again. So it's really hard to get a read on what GM is seeing. Ford is really trying to keep expectations low. Ford keeps saying, assume the worst in terms of sales here the next 6 months. And, even in that context, Ford is saying we're still okay, in terms of cash for now, and we don't anticipate any problems.
With GM sending mixed signals and Ford assuming the worst, expectations are not high for a quick rebound. But what about the possibility of bankruptcies? Analysts are assuming the worst.
Well, I think that GM is going to continue to need money, and I think the GM that we know 12 months from now is going to look very different than the GM we know now. If I was a betting man, I'd take 50-50 on General Motors ending up in bankruptcy. Ford, I see as a survivor, and Ford, to my mind, actually benefits from any further weakness at Chrysler and GM because, like I said, the products are going to be more competitive and, less competition to face. Chrysler, I would bet, is a goner in 6 or 9 months, except for the Jeep line and for the truck line.
With that said, the Stillman Exchange firmly believes the domestic auto builders will be back for more cash in the beginning of Q2. Sales have not rebounded, credit remains tight, and new products have yet to hit the showroom's floors. You thought 2008 was rough? You haven't seen anything yet.
We sincerely hope you enjoyed our videos. This concludes our presentation. Thank you for your attention and your continued support of the Stillman Exchange.
That was a great job. I think you're giving 60 Minutes a run for their money. And by the way, our budget was far less than that of 60 Minutes. Now we'd like to move on to our panel discussion. I'd like to begin by introducing Mike Huckman, tonight's panel moderator. Mike is a CNBC pharmaceuticals reporter covering the drug, biotechnology, and medical device industries. Mike joined CNBC in September 2000 after 9 years at WXYZ in Detroit. Prior to that, he served as general assignment reporter at KGUN in Tucson, Arizona, KBCI in Boise, Idaho, and as anchor producer for the Montana Television Network. I'd also add that he is a local resident of the Seton Hall area. Mike has won numerous rewards for his reporting, including 3 Michigan Emmy Awards, 1 for business and financial reporting, as well as first place News Series Award from the Michigan Association of Broadcasters. Mike, welcome to Seton Hall.
Good evening. Thanks for having me here. Just a couple of thoughts. First of all, on what we just saw and heard. First of all, I think it's remarkable to hear about a newspaper that's expanding these days, so congratulations on that. And then second of all, to see young people who are interested in doing what I do, because when I was coming up, there was no such animal as TV business news reporting. CNN had just come onto the scene, so we were just seeing cable news to begin with. And when I was in school, nobody even thought that someday there would be, let alone one business TV network, but now we've got at least 3 of them, at least last time I checked. I don't know if you heard, but Bloomberg announced today that it's laying off, I think, 60 or 70 people in TV and radio. So the only quibble I have is that, as Scott mentioned, I worked in Detroit for about 10 years, is that most of the reporters I know now are referring to them as the Detroit 3, since they're really no longer the big 3, I think, with Toyota's numbers that they recently put up. So I look forward to an informative and lively discussion here tonight. Unfortunately, James Altucher could not join us, but we still have 2 rock stars to roll things along here. I wish I could have been able to come here this evening and gloat about my USC Trojans beating Seton Hall in basketball a couple of months ago. But yeah, you guys had to go ahead and come from behind. I think it was like a 43-28 halftime deficit. And because we didn't make a three-point shot at the buzzer, we ended up losing to you guys at the final second, obviously. The only consolation for me, at least, is that you guys are now 11-9 last time I checked, and we're 15-6 heading into tonight's tough game against the UCLA Bruins. Anyway, as Scott mentioned, I cover pharma and biotech for CNBC, and although I did get pressed into some coverage of the Bernie Madoff scandal recently, I was pretty much relegated, frankly, to the sidelines as the financial crisis began to unfold last summer and fall. I mean, it was wall-to-wall Wall Street coverage, if you will, and justifiably so. So unless I had a major deal coming out of my sector, and there were no major deals going on, obviously, in any sector at that time, or a big-time drug was being pulled off the market, I didn't have a chance of getting on television through all that. And at the time, I and some of my other colleagues who happened to cover beats that were not related to Wall Street and the financials and the banks and what have you, we'd sit around and joke about the fact that we were just highly paid bloggers. By the way, speaking of blogs, mine is farmersmarket.cnbc.com. That's P-H-A-R-M-A-S. Farmers Market. I didn't come up with it, though. I wish I did. Although now that the initial shock has worn off regarding the financial crisis, it's much less of a challenge for me to cover my sector. And I think it's worth noting that two big deals in biopharma could possibly lead the way back into a big M&A cycle. So, of course, we've got Pfizer now having to cobble together a 5-bank syndicate to pull off what at least was valued at a $68 billion acquisition of Wyeth, although that's since come down because Pfizer stock got hammered last week on the news. And then we still have Roche as late as today, which also has big operations in New Jersey along with Wyeth, reaffirming its commitment to take Genentech private for, I think it's $40 billion plus. And there's another less noticeable way that the crisis kind of dovetails into my sector, and that is I just did an interview yesterday with a key opinion leading psychiatrist in New York City who said that he has seen a dramatic increase in the number of people who are not just coming into his office, but who are going to shrinks all across the country as these layoffs mount up in every sector of the economy. And what's being done, those people are not only going into therapy, they're being prescribed antidepressants, of course. So to sum up what we're going to talk about tonight, though, unimaginable collapses of firms that were household names in the United States, the auto industry turmoil that we just heard a lot about, massive layoffs, astronomical rescue, bailout, and stimulus packages. Take your pick in terms of what you want to call them. I know there's a debate even within that in terms of the semantics. A destruction of wealth in the housing market and in the stock market. Bernie Madoff, as I mentioned, in his $50 billion Ponzi scheme. John Thane in his $1,400 trash can and his $35,000 commode with legs, whatever that is. There is no shortage of stuff for our distinguished panelists to talk about here this evening. So I'm not going to recite their resumes and their bios. You can read about them. I assume you've actually already done that, about their genuine street cred in the program. And of course, anybody who watches CNBC knows that we love to frame our debates or shouting matches by calling them bull-bear debates. Somebody's always got to be the bull, the other one's got to be the bear. But after doing a conference call with these two gentlemen the other day, the impression I got actually is that they're both bearish, although one, I think, is arguably a much bigger bear than the other. But you'll find out in just a minute. So each of them are going to give a formal presentation. Then we're going to open it up for questions from you guys. I'll go over the ground rules for the Q&A when they're done. But suffice to say, at this moment, just as you're thinking about your question as they're making their presentations, begin to edit it in your head. So please try to keep it short. So with that, it is my pleasure to introduce Dave Ressler and Chip Dixon. Please give them a warm welcome, and we'll start with Chip. Chip, you're first.
Okay, thanks, Mike. I want to thank Seton Hall for inviting me to do this again, and to the Stillman Exchange and the people who put that wonderful, those wonderful presentations together. That was a great job. Okay, I have some slides. Okay, I call this era the Great Deleveraging. We like to give labels to economic eras. There was the Great Depression. Mr. Samuelson just wrote a book called The Great Inflation, which I recommend, about the 70s and the 60s. And I think this era can justifiably be called the Great Deleveraging, because that's what we're seeing. This is a book that was written before we knew we were getting into the Great Deleveraging, but I think it talks to the financial services industry and some of the problems that we were dealing with. It says the financial markets we have constructed are now so complex and the speed of the transactions so fast that apparently isolated actions and even minor events can have catastrophic consequences. I think we also really didn't know what we had going on here, and that talks to the complexity of what was the financial services industry. So the current environment, I think we're in a bear wave. And when I say a bear wave, I'm not talking about just a bear market or a bull market. I look at these in terms of a longer duration. And it takes time for a bear wave to end and a bull wave to begin, just as it takes a long time for a bull wave to end and a bear wave to begin. I'd say in the United States, this bear wave began in March 2000 with the tech bubble. I'd say the bull wave that preceded it started around 1982, and that the bear wave before that started in around 1965. And you can go back. As I said, this is the great deleveraging, and as you'll see in a few charts, there has been a tremendous buildup in debt. And when people talk about the recession, it is certainly hitting the consumer very hard and is beginning to hit businesses. But I think it was triggered by the excesses in the financial services industry, and in many respects, I consider it a financial recession. And I don't see historic comparables. I see bits and pieces, but there hasn't been a point when we built up debt throughout the system as high as we did and have it collapse to trigger the problems we have. You will see that debt got high before, but it was after the economy went into recession, depression, not as it was going into recession. So as you look for historical comparables, it's important to say, even though it's dangerous, this time some things are different and you have to appreciate some of the changes that have taken place. What happened? Well, there's been a pervasive increase in leverage, as I said. And in almost all parts of the economy, probably the only place you can say is non-financial corporate America behaved pretty well. But the government didn't behave well, household America got caught up in it, and the financial services industry certainly did. I think the fact that we have not had a reasonable or any kind of coherent energy policy also added to the problem, because it created or allowed a lot of imbalances to be created. We also had the tech bubble, Y2K, Enron, WorldCom, et cetera. I say those things quickly together because they all occurred at the end of the last decade. And the tech bubble was the first major equity euphoria, or the largest equity euphoria since 1929 in the United States. Why is that important? Because when a euphoria ends in the equity market, best I can see, it takes about 30 months for things to bottom. And it took a while for the markets to bottom then. There was tremendous pressure on the economy coming into this decade, and it was caused by these events. And these events brought about an era of easy money. That easy money, I think, was the power of that easy money was enhanced by what I call off-balance sheet or off-budget social policy, which ultimately saw its way through to seeing a rapid decline in underwriting standards in the financial services industry. When I covered banks for 15 years, usually banks looked at loans as something that they were going to hold on their balance sheet. So you had it, you underwrote it to hold. And somewhere in the middle of this past decade, financial services industries, companies decided, let's originate to sell. Somebody else is going to take care of it. Maybe the rating agencies are going to even notice and help us with the ratings on these things. But that didn't happen, and we saw a tremendous decline in underwriting standards. And as a result, there were tremendous unintended consequences and a huge buildup of systemic risk. I put these in, and it was mentioned in the presentation before on China and what can get us out of this. But the IMF sees things declining a lot this year, and they see things worse for the advanced economies than they'd see for the emerging and developing economies. Interesting, as tough as it seems in the US, it's also worse in many other countries. Japan is still suffering a lot. In terms of how the IMF looks at kind of the output loss caused by these downturns, you can see for the advanced economies, it feels about as bad as it's ever been, close to the 80, 83, and 74, 75 period. For the world, it's as bad as it's been in the past recessions going back to 74. The emerging markets also get hit harder. And this is a concern, I think, in terms of how we get out of this, because the imbalances in government fiscal budgets around the world are just as bad as they've been. The governments seem to have less flexibility. Deficits are expected to get larger, and maybe they'll have less flexibility, but I think that's a big issue that has to be addressed. Now, how's this all affected the markets? Well, in the bull market that ended in 2000, but continued really globally into 2007 because the other global markets really took off. In fact, if you invested in a global portfolio of stocks of just that matched the world index in 2002 and pulled out at the end of 2007, you got about 25% compound annual returns. It was a good time to invest globally, less so in the US. Those returns, the returns that were realized through 2007, say in about a 25-year period, a little less than half of them were eliminated last year. And it wasn't like one country took the pain, everybody did. $18.1 billion. This chart is pulled off of a website called dshort.com, so if anybody wants to go and look at it and pull up the charts for themselves and use them, go ahead. But it gives you a sense of where we are using a regression to trend analysis and a real price since 1875 with he did all the work for me, so I like that. And you can see we've had peak years, and it looks like we're going to be in for weaker performance right now, which corresponds to what I just said. This bear market is down a little, almost 50%. It got down as low as declined as much as 52% on November 20th. And at that point, we were 13 and a half months into it. We're now about 15 and a half months. How does that compare to prior major bear markets using the Depression, the 73, 74 period in 2000? Well, this went down farther than two of the three. It's clearly not as bad as the Great Depression, which went down 80%, and I'm certainly not looking for that. But there's still a lot of issues to be dealt with, and the duration of this is certainly not as long as the 73, 74 period and the tech bubble. A couple things I think you're beginning to learn about investing, or maybe some conventional wisdom is being tossed out, and that is the buy and hold doesn't work. Stocks are not always a great place to be. You have to pay attention to the environment. I, in fact, think you need to understand whether you're investing in a period that's a bear wave or a bull wave. What's the difference? If you're in a bear wave, return of capital becomes more important than return on capital, because even though it might look good, you may never get your capital back. Look what's happened with the financial services business. Indeed, the financial services sector of the S&P 500 reached a peak market capitalization of $2.9 trillion, I think, at the end of 2006. It's now $700 billion. So there's been a lot of wealth destroyed, and it's not coming back if you just held on to it. Indeed, many of the companies are no longer in existence. There's also been some decades when it's just not been a very friendly time to invest, and that's because of the economy. and some of the issues at place. For instance, the 30s and 40s were a very difficult time to invest. In fact, if you look at the 40s, very little worked. You hardly got any positive returns. I think the commodity index was about it for the decade. And the 70s and the 60s were also not very friendly periods to invest. The 70s, these are real returns. And if you invested in the U.S. equity markets around 1965 and stayed in until 1982, you ended up about flat when you came out. Very difficult time to invest. Inflation destroys a lot of value. This decade's also been tough, and it's been tough for reasons we understand. So my point is, you have to understand the environment. We're in a difficult one right now. Sometimes, and in the asset classes, you know, the buy and hold strategy, even diversification didn't work now. The reason it didn't work this time was because there was so much leverage in the system, and it was global. Unlike Japan in 1990. In fact, Japan is still arguably in a bear market since the end of 1989. Unlike Japan, which was focused on one country, this was global. People were losing money. There was deleveraging. There had to be a sale of assets to be able to pay debts off and to redeem money, et cetera. And it affected almost all the asset classes. So the idea of diversification didn't help either. Return of capital and flight to safety became almost the best ways to invest. One of the reasons we had so much leverage build up is because almost universally in this country, we thought owning a home was a great thing and more people ought to do it. And so we created incentives for it. We created laws and policies for it. And we pushed home ownership rates up probably farther than they should have gone. We did it with debt. As a result, we saw prices in houses go up faster than they should have. Housing prices usually don't go up as fast as they did in the last decade, and we're seeing a pullback now. And that debt buildup is evident in this chart, debt to U.S. GDP. You can see two ramp-ups here, one in the mid-'80s and then at the end of the '90s. There was, of course, more leverage built up after, and debt became more affordable after we wound down inflation. People started investing again. But at the end of the '90s, there was more of a euphoria building up, and we started developing more aggressively something called the shadow banking system, which is a lot of off-balance sheet assets which didn't have a lot of capital tied to them and derivatives and things like that. You're going to see. No, that's okay. Great question. This is what it was. So, and this is hard to read. I apologize. The bottom blue is household. Non-financial corporation is next. And then you see farm, the state and local governments, the federal government, rest of the world, small sliver, and then financials is at the top. The fastest growth was in the financial sector. However, the financial sector includes Fannie and Freddie. And without the government support, I don't think they would have been able to borrow nearly as much as they did with the leverage they had at the yields they offered. If you add Fannie and Freddie to the government debt, you can see it goes from being about little over 50% of U.S. GDP when I did this now to closer to 90. And I just want to go back here. You can see we got as high as 350%. Well, in the mid-30s, early 30s, we got to 300%. So this is a very high level of debt to have now, and the prospects of even higher debt are something that is not something that I would say is going to get us out of the bear wave. So Freddie and Fannie. The red line is average managed assets for these two companies. The dark line that you see is average earning assets, what they have on their balance sheet, and that very line at the bottom is equity. This is their on-balance sheet leverage. This is what I would call the traditional banking system. And they had leverage in, mark-to-market accounting, realizing some of the losses from their subprime and Alt-A exposure meant that they had leverage of almost 100-to-1 on tangible common equity. And just as a side note, for financial services companies, tangible common equity that's your levy. That's what you have to stop everything. And the thinner that gets, the weaker the organization is. This is the shadow banking system, almost 600-to-1 if you add the average the managed assets in. Somebody has to take them on. When things got bad, it turns out they came back on the balance sheet. So there was a lot of leverage in the system that we wanted to pretend or we didn't want to think about, but it created tremendous systemic risk, and we're beginning to feel the pain right now. So, what's happened? Well, the market's not, as we know, doing that well. There's a lot more volatility. The VIX, of course, is a measure of volatility, and you can see it looks like there's a reasonable correlation between, not a perfect one, but between the volatility in the market and where the S&P 500 is going. And the VIX has come down recently, but when I was a strategist on Wall Street, the VIX was really closer to 10, and a lot of people wondered if that was permanent. Well, it's not. And one of the reasons the VIX got so high is this. Credit spreads remain very wide. By the way, you can get the credit spreads. You can do that by using the St. Louis Fed website, FRED, and you can download data. You can create thousands of charts on your own free. They do it for you almost, so I'd encourage you to use FRED. But right now, credit spreads, and I just updated it today, so it's through the end of January. The lesser quality paper cost a lot more on an absolute and relative basis. And that tells you that the credit markets still, while they seem to be getting a little bit better, aren't that healthy yet. Some good news, we're already in negative territory. If you bought stocks 10 years ago, you're losing money right now. Why is that good news? Because you don't do that forever, okay? And at some point, stock prices get low enough, create enough value that if you have a long enough holding period, you can invest and make some money. And the Fed model would tell you, and the Fed model takes the PE of the S&P 500 and compares it to the 10-year Treasury rate. You have to convert that to a PE, or you convert them both to yields, but it says the market's cheap now. I think it also tells you that risk aversion is very high, and I think that's the bigger message. We're in a period of high risk aversion. We're in a period of high risk aversion because we entered a period and we levered too much. We created a lot of systemic risk. We didn't understand the unintended consequences. We inflated asset values in a way we probably shouldn't have. And now we're adjusting to that, and there's not a good roadmap in terms of how you adjust to that, so risk aversion is high. As a result, I would conclude by telling you we are still in the midst of a bear wave. The probability of a bull rally is growing, but I don't think it's a bull wave. It's just a bull rally. The fundamentals are not in place. The fundamental changes required for a bull wave are not in place. That will take a lot of time, and you have to watch what the government does. We have to watch what the values in the market are. And I wish I could leave you with on a more optimistic note, but I can't. I would also just leave you with one other thought. The returns that you get if you participate in a bull market, over half of them are typically eliminated by the next bear market. So you need to understand the waves you're in and adjust accordingly. Those are my comments. I look forward to your questions.
Chip, thank you for imparting all that gloom and doom, and now for even more. We're going to gain altitude and move from kind of an equities and markets perspective way up to a macro and much more global perspective with Dave Ressler.
Thanks, Mike. It's great to be here, even though I learned a few minutes ago that I have to share the podium with a USC grad. As a PhD from Ohio State, I have very painful memories of conflicts with USC in football. And basketball's a nice sport, but not played by real men. And unfortunately, after all, it is a women's sport too. Anyway, Mike gets all the awards for a good football team right now. Ohio State, unfortunately, hasn't fared that well in the national arena in the last couple of years, although apparently they played a good game on January 5th, losing in the last few minutes. I happened to be in India, and actually I have a couple quick comments because we're listening to, and I'll have some other things to say about the auto industry, but being in India exposes you to a different way in which people view automobiles and transportation. In India, a Volkswagen is a 20-passenger bus. And if you don't believe me, I have pictures to prove it. What do they call those little things? What? Yes, auto rickshaws. They're designed to hold 3 people, but more typically if it's non-tourists, there are usually 6 or 8 in those things. And in that country, and I think it's probably typical of developing countries generally, if it has wheels and a motor, it's a means of transportation. It's not a lifestyle. It's not how you define your existence, as the motor vehicles are in our culture. And I'll have some more to say about that in a second. Well, let's talk about where the U.S. economy and the global economy is right now and where I think we're headed. We hear all kinds of superlatives comparing the U.S. economy now to the Great Depression. Those hopefully will not prove to be accurate. Right now, if we're looking for benchmarks to see how, when was it last this bad, if you're looking in terms of things like unemployment, growth in real GDP, conventional macroeconomic measures of the economy's performance, we have to go back to either 1981-82 or 74-75. Those were the 2 worst recessions in the post-war period. Each lasted 16 months. In 73-75, which in many ways was the worst, we had a decline in real GDP over a 5-quarter period of 3.1%. That was peak-to-trough decline. In 81-82, we had a 2.6% decline over a 5-quarter period. That also was a 16-month-long recession. So far in this recession, we've had 2 quarterly declines in real GDP of 0.5% and 3.8%. Now, I think that we're going to have a bigger decline in the first quarter, probably in the neighborhood of 5.5 or so. Another decline probably in the second quarter. But by the second half of this year, I think there's reason to be hopeful and somewhat optimistic that the consensus view that we come out of a period of decline into a period of growth, I don't necessarily want to call it a recovery, will develop by the middle of the year. And I can explore either in questions or if I get to it in my brief comments here, we can explore some of the reasons why I think that's a reasonable expectation. The performance of the U.S. economy, as bad as it is, and it does feel bad, I think it probably feels to many of you much worse than an objective assessment of the reality would justify. And a few years ago, I started to notice that CNBC and, well, Fox Business News wasn't around yet, but Bloomberg and other pundits were kind of always reminding us of just how bad things were getting when they weren't really bad yet. I mean, they're bad now. I'm not denying that. But we were hearing about how bad things were before they were really bad. And I started to think about why is it that there's this perception that the economy is so much worse than it actually is. And one of the reasons, I think, is that we're all a product of our own experience in life and what we've been through. And people of my generation, I graduated from undergraduate school in 1969, In the first 13 years after graduation from undergraduate school, the U.S. economy, 13 years is 156 months, the U.S. economy was in recession for 50 months. That's 1 out of every 3 months of my first 13 years as a working age adult. We were in recession. Let's fast forward to somebody who graduated, say, in 1994. The first 13 years he was in the job market, the U.S. economy experienced a grand total of 8 months of recession. Very different experience for somebody in their mid-30s going into this downturn than was the experience of me going into the first, within 6 months of graduation, we were in an 11-month-long recession. We haven't had an 11-month-long recession until the one we're in now in 20-some years. We also had 2 severe recessions, both which had similar precedent to the current one. Some of us forget that while there's no question that the financial market catastrophe that we're witnessing is a big part of this downturn in the economy, there's also a big role that was played in this downturn, just like it has in every post-war or every recession since 1973. And that is a steep run-up in oil prices as a precedent to a downturn in the overall economy. How does that work? Well, when oil prices rise suddenly and rapidly, as they did the first part of last year, as they did in 1973-74, as they did in 1979-80, before the 81 recession, and as they did in 1990, just as the 1991 recession was getting underway, and as they did also in 2000, what happens is that people are forced to cut back on some sort of spending, because one thing most people, especially outside of areas like this where you have good public transportation, is that transportation is necessary part of your life. If you're going to keep your job, and most people do, and certainly most people want to, they have to drive to get there. But that means if gasoline prices have just taken up an extra 4 or 5% of their income, they have to cut other kinds of spending. And when they cut other kinds of spending, you get a chain reaction of events. That's happened this time. It was one of the critical factors, I think, that tipped the scale from what was looking like a very weak, soggy economy that we might have muddled through without it lasting long enough to be a recession in the first half of last year, had it not been for the spike in energy prices during the first half of last year. The decline in energy prices since then hasn't been enough to offset that. We've now set in motion a chain of events that is feeding upon itself. Declining demand for discretionary goods, leading to declining employment for those who produce them, declining employment leading to declines in personal income, further reductions in consumer spending, a vicious cycle, downward cycle now underway. And it's going to be partly mitigated by the declines in prices that we've seen since then, since the middle of last year, but not fully. So that's part of the comparison of this past recession, of this recession to those of the past. There's another precedent, too, is that most recessions in the U.S. have had a significant downturn in the housing sector that either precedes the overall economy tipping into recession or coincides with it tipping into recession. The current housing market recession began in a sales sense in the beginning or the middle of 2006 when prices were at their peak. We began in a production sense shortly thereafter with declines in housing starts, and we now have the lowest housing starts recorded in that data series history, which goes back to about 1959, by the way, so it's not, since BC, 10 BC or whatever. But it is a very severe downturn. I, a year ago, had hoped that we would reach a kind of plateau or bottom in the price declines in the housing market, that we'd liquidate the excess inventories faster than we did, and it'd set the stage for some production gains. Didn't happen, and the fear that I had beginning a year and a half, 2 years ago, was that a downturn in housing, if it lasted long enough, would begin to filter into other sectors of the economy, pulling everything down through this kind of chain reaction of weak demand, weak employment, pulling down income, pulling down demand more, and it just spreads. Well, that's exactly what happened. Now, all of this, of course, has been aggravated by the financial market debacle, which really we might have muddled through everything had it not been for Lehman Brothers' collapse last September. But that was the final straw that broke the U.S. and world economy, and broke it badly. The financial markets froze up. Equity prices tumbled. Most of the decline in stock prices last year occurred after September. The U.S. household sector has lost, in the last 4 quarters or so, close to $10 trillion in household wealth. That's from about a household wealth total of about $50 trillion. That's a huge loss in wealth. It alone would imply a significant reduction in consumer spending on the order of $300 to $500 billion over the course of a year or so. And indeed, that's what we're seeing happen, is that consumers are scaling back, first because they faced high prices, now because they have an enormous loss of wealth in the form of 401k plans, in the form of the net equity in their house, and in the form of their direct holdings of equities. So this has been a very severe economic downturn. It could be worse, believe it or not. Instead, it's more global. And I want to call attention to a couple of startling facts. One is that there's this notion that began to circulate a couple years ago that the global economy had become, because of the strength of and extraordinary growth in China and India, the rest of the world economy was becoming decoupled from the dependency upon the U.S. economy. U.S. consumers were certainly still a driving force in the global economy, but less so, so the argument went. Well, the facts are a little bit otherwise. 35% of what we consume, of what we buy, of the goods that we buy, I'm not talking about services, because you can't really import haircuts very easily. And you can't import other forms of services very easily. But 35% of the goods that we buy are imported. In the last recession, that number was about 31%. In 1990, it was around 25%. So the rest of the world, which derives its benefits from the U.S. economy through what we import, it's what they export, we import a much larger share. So if the U.S. economy, if the demand for goods falls by 10%, the demand for goods produced overseas accounts for 3.5% of that decline in demand of 10%. We all know, or have read, if you're reading the papers very often, you know that the U.S. has benefited greatly from the expansion of global trade, that our exports have been a key contributor to the economy's growth in the last couple of years, and in fact was the major factor preventing us from being in a recession earlier in 2008. That's because we also export about 25% of what we make. In 1990, we exported only about 15% of what we make. So trade is much more important than it's ever been in the U.S. economy, in the global economy. This is a global phenomenon. So can we be surprised that the U.S. economy when the U.S. economy slides into recession, it redounds to adverse effects elsewhere? No, we can't. And in fact, we're seeing an enormous hit on some of our best trading partners' economies. The Japanese economy has experienced an annualized rate of decline in exports the last couple of months in excess of, I believe it's like, I think we had 1 month decline of 14% in a single month. So you analyze that, that's what, 168%? The Japanese economy exports are subtracting from the Japanese economy's growth close to 9% from its economy's performance, just exports alone. Unfortunately, the rest of the economy is not doing very well either. And in a few days, I think on the 16th of February, Japan will report its fourth quarter GDP numbers that will be close to 3 or 4 times worse than the growth in the U.S. We expect to see growth in Japan, or actually a decline in real GDP at an annualized rate in the fourth quarter of 2008 in excess of 10%, like 11%. The first quarter is not much better, by the way, in our Tokyo economist scheme of things. So what we're seeing is an enormously severe global recession. And Japan, of course, exports to other parts of Asia. It's not just their exports to the U.S. that are getting hit. Their exports to China are very important. Chinese exports are now starting to shrink. Chinese imports are also starting to shrink. And the Chinese economy won't be growing 12% anymore. Nomura's economists in Hong Kong are forecasting growth in China this year of about 8%. That's pretty optimistic. However, they think that that's a reasonably good forecast. Let's hope it's so, because China's growth at 8% would help the world economy avoid negative growth, although I think it's quite likely, as you saw in that video earlier, the IMF has lowered its forecast for this year to 0.5. I think there's almost no chance that we'll get a positive growth number in 2009. So where do I see the U.S. economy from here? I think that we have reason to hope that we'll get to some sort of positive growth in the second half of this year, gradually working toward the economy's long-run growth potential of 2.5 to 3, perhaps by the end of 2009. The unemployment rate's likely to get to 9.5, maybe even 10% this year or early next year. But it's not the end of the world. It's maybe the end of the recent world as we knew it, but it's not the end of the world. And that we can talk about fiscal stimulus, sacred cows, pork, you name it.
So, gentlemen, I'm going to ask you to, if there's enough slack there, to actually grab those microphones in your hands, because otherwise you're going to be leaning forward, either with the stand or pull it out of the clamp, so we can hear you as you answer. And then for those of you who do want to ask questions, there's a young man named Josh who's going to play Phil Donahue or Oprah Winfrey and run around. And if he comes to you, please just tell us your name, your affiliation, who your question is for, and then again, please keep your question brief, to the point, no speechifying, as I like to say, because I will cut you off and say, what's your question? So just to get things going, I'd like to first ask Chip, and check you a little bit, because you basically turned conventional investment wisdom on its ear. You told us tonight that diversification doesn't work, and you said buy and hold doesn't work. So what in the heck is an investor to do?
What I said was, you're right, buy and hold doesn't work. It will work in some environments, but you have to know the environment you're in. And we're not in an environment where it works. And buy and hold over the long term absolutely doesn't work.
And diversification?
Diversification in this environment fell apart. And it fell apart because of all the leverage in the system and the need for deleveraging and just the fire sales in so many asset classes and the pressure for redemption. And a lot of people invested in financial services at the beginning of 2008, even in 2007, thinking, okay, we've gotten the pain behind us, let's get in. Boom. And a lot of people didn't understand the severity of the subprime crisis. I don't think many people could have predicted that. And to Dave's point about Lehman, when Lehman went bankrupt, what happened was the counterparty mechanism in the financial services industry stopped working. The heart of the engine didn't work anymore. Financial companies weren't willing to extend short-term credit that was secured to each other because they didn't trust the assets and they didn't trust each other. And so now we basically have the government guaranteeing that. But that wholesale deleveraging meant that there was just selling of assets, and when you have to sell something, you have to sell it, even if it's an asset you want to hold on to. That put pressure on a whole lot of stock prices, and it was global, and it was in most asset classes.
And then, Dave, for you, have to get an answer from you, please, on the federal stimulus proposal. Today, of course, we all heard that the president doesn't want executives who are getting taxpayer money to make more than $500,000 a year. Is the new administration going about this in the right way?
Short answer is I don't think so. And in terms of and partly my disappointment over the progress so far on developing a fiscal stimulus is I see it as an opportunity lost to do some things that could be helpful in jump-starting the economy through stimulating final demand. The theory behind the fiscal stimulus approach that's being taken by the government right now is that spending has a bigger multiplier than tax cuts. Spending increases have a bigger multiplier than tax cuts. Hits the economy with more bang for the buck. First, the literature on that is quite, would question that conclusion. But even if one accepts the old Keynesian view that that's the way the world works, it's also clear that in order for the spending to have an impact, for that bigger multiplier to have an impact, it has to be a comparable dollar amount. And there's just simply no way that you're going to be able to get the kind of spending on goods and services bought by the government through the proposal that was passed by the House last week that will do much to the economy this year. The Congressional Budget Office indicated that only about $26 billion out of the $360 billion or so targeted for infrastructure spending would hit this year. That's probably about right. By the time it passes, we've only got about 7 or 8 months in the fiscal year, and only maybe $110 billion would hit next year. So that's not a very potent stimulus. And just thinking about it in a common sense sort of way, if you have a infrastructure plan and you're only going to implement shovel-ready projects, as they call them, it still takes time to contract for the spending, contract for the job, and you usually pay as you go. The governments pay for progress made in the building of a bridge or whatever. And you don't build a bridge in 6 months. You don't build a kitchen in 6 months, as I found out a few years ago. So, to get this kind of spending out in the economy in the timely fashion just isn't going to work with what they're talking about doing.
So let's turn up the house lights, please. And I had to hit you back before we go to the audience. Ohio State has a chance for revenge, by the way, in Columbus on September 12th.
Mike, but I just like to add one thing.
Say your prayers.
Well, just for what it's worth, USC has the second best recruiting class according to Sports Illustrated. Ohio State 3 and Michigan is a distant 10, but I'm sure they found some good ones.
Can we scrounge up some tickets for all of us to go to the Seton Hall, Connecticut game? All right, we'll get them into a real arena, not the second-rate place. So let's see if we can scrounge up some tickets and we'll all go.
Thank you.
But just on the issue of the government policy, and I've been talking about deleveraging, if you want to reduce the severity of a period of deleveraging, aside from writing off all the debts, one of the things you're seeing required is happening. They're trying to get more equity into the financial system because most every financial company became a lot more levered in the last 10 years. And it wasn't just because the economy was bad, they did it deliberately. Okay, so we're getting more equity in. The other side of the coin is a cash flow side. And if you want to help reduce the severity of a deleveraging, you need to have people have more cash flow, individuals and corporations. And that isn't going to happen with government spending. It's going to happen with tax cuts.
Josh, you're up. So please raise your hand, and Josh will come to you. Just like Phil Donahue.
Hi, I'm Paula Alexander in the School of Business. My question is for Chip, and I'd like to hear what you think are the fundamental changes required for the bull wave.
So for recording purposes, in case it doesn't get on there, the question was, what do you think are the fundamentals needed for a bull wave?
Right, his last point on the summary.
Yeah, just so you know, I'm trying to complete a book with a professor from Ohio State.
Good choice.
Who also wrote the book, The Chinese Century, but it was focused initially on global investing, and it's evolved a bit. It looks like bull waves start, there's a couple characteristics. One is very low valuation. And if you go back to the early 80s, valuations were very low. If you go back to the 50s, the beginning of the 50s, valuations were also very low. I also think there's a change in the structure of the economy. And you go from one that is more government interventionist, where concentration of decision-making has grown and increased over time, as you saw happen in the 30s and the 40s, to one where the economies, on a relative basis, open up. Consider what happened at the end of the 40s, early 50s, and that is, we stopped being a war machine and we actually became an economy again. People started living their lives and forming households, and we built houses, things like that, and there was more consumer demand. And the level of government decision-making relatively began to decline, and people's involvement in society grew. But that also became true in other countries, most of Europe and Japan. So in terms of the relative opening of the global economy, it was significant. Well, that began to close again sometime in the mid-60s, especially in the United States and a good part of Europe. Japan kept going, where social policy, we had the war on poverty, the Vietnam War, things like that, and then we had the inflation, which I think is another just a way of debasing the currency, and that meant people had less control over their lives. That ended in the early 80s. And there was just a shift in the economy away from a lot of government involvement to a more open economy. And again, it began to be more global as other economies joined in, UK and then the US. But you saw it happen more globally, and eventually China and other countries. But there were the seeds of what I would call greater government intervention, or channeling of the capital allocation with things like our housing policy that distorted things. So valuation, just how much can you have more of a crowd than a herd kind of instinct in society, and then just what is the demand. If there's a lot more demand, you saw that in the early 80s. People hadn't, there was consumers just weren't full up at that point. So you probably have to see debt down too.
Next question, please. Raise your hand. Up in front, over here, all the way down in the corner.
Getting a workout.
Yeah.
I didn't do this before, but please state your name and affiliation.
Oh, okay. Conley, I graduated at Seton Hall in 2003, currently an MBA student here. Question is for both presenters, actually. With the current capital injection that was given to Citibank and Bank of America, what do you think it's going to take for these two banks and all financial institutions to actually start lending at a normal rate again? I know they're open for business, but lending standards have been really tight on corporate lending.
All right. So the question is, when does lending start at quote-unquote normal rate?
Well, I want to start answering that question with an anecdote. I was actually trying to find something in the mail that had arrived, but my wife hadn't bothered to show me, so I was going through the trash the other day. And what I found in that trash of mostly junk mail was 4, count them, 4 credit card solicitations in the last 4 weeks. I don't think I've seen any in the previous 8 months. Now, you know, I'm a great credit, and they should be soliciting my business. But to me, it's a sign that things might be opening up. And you know, while the president is worried about compensation of executives for the banks and others receiving government money, maybe he should be more worried about the rest of this anecdote. I have a bank account with Bank of America. Now, it was not Bank of America when I started, but it was the same building. I think it's been through 6 iterations of companies in the last 23 years. But I went there last Saturday to just get some cash out. And in one of these credit card solicitations, Bank of America is offering me a $25,000 line of credit, 0 interest for a year. Good deal, right? I mean, it's almost like borrowing at the Federal Reserve. And this gentleman at the counter said, you know, he noticed that I had only a passbook savings account for the piddling amount of money I keep in the bank, and I was only getting about 1 1/4. He said, didn't I want to get 1 3/4 on a 9-month CD, which I would be restricted from withdrawal for the first 30 days, but then after that it really isn't really a 9-month CD. It's just kind of floating CD. But it's fixed at 1 3/4 for 9 months. So my thought was, now what I should have done, I hadn't opened this credit card line of credit yet, but I should have gotten the $25,000 right then and there, deposited it for $1 or at 1 3/4 for 9 months. And when the loan is due, when I have to actually start paying interest on this, pay it off with the CD money. I mean, that's free 1 3/4% at the expense of the Bank of America shareholders. If they're doing that very often, they have no hope of recovering to profitability. But to get to the question about credit growth and the hand-wringing we hear in Washington about the lack of credit growth, the reality is, as Chip's been telling us, this is a deleveraging cycle. And deleveraging, it's not just banks and not just car companies, it's households. Everybody is in this deleveraging business, in this deleveraging process. That means that you have to restore savings, reduce spending, and get your financial house in order. You don't do that by borrowing and spending. So the fundamental reality is that we've got to go through a period of relatively sluggish growth in credit, making sure that the credit that does get extended goes to people who actually can repay it. That's always a good idea. And frankly, we're seeing some of that happen, especially at the banks that aren't in the protected class, the too big to fail. They're in the too small to succeed, I guess.
I just would like to say, Paul Volcker said today that some banks are too big to survive. And I think he's saying that, you know, this too big to fail doctrine has to be revisited. Clearly, my concern of hearing Washington always pound the drum and saying, we have to lend more, we have to lend more, that's not it shows they don't really understand the industry. The industry has to get healthy, and it's got to repair its balance sheet so it can provide the liquidity mechanism necessary to keep the economy growing and to rebuild the trust that doesn't exist today. Too many of the banks that exist today got to where they are by executing a strategy that was really a goal. They wanted to get big. Getting big is a goal, it's not a strategy, and it doesn't mean you're good at what they do. Their business model of most large banks is broken. And the banks, and I'm talking my own book here because I'm investing in some community banks, but the good community banks have a great opportunity. And if you have a deposit-driven strategy, you can gain a lot of share in almost any local market. You can create a lot of growth, and you will be one of the survivors and the leaders. of the next decade.
So are you gentlemen saying that the rhetoric that we're hearing on a daily basis right now, that as soon as we get those banks lending money again, we're going to be on the road to recovery, and that's not true?
Well, it might be true that if they were lending money foolishly, we'd be temporarily on the road to recovery, but that recovery would prove to be short-lived, and we'd end up back where we are now or worse. There's also another thing, I think, a misconception about what happened post-September. And by the way, I would amend Chip's comments about the seizure of the capital markets post-Lehman, is actually that was kind of a re-seizure. We had gone through a period of similar seizure for a brief period in the spring, and it was just starting to get better in June, July, up until the Fannie and Freddie takeover by the government. And then things started to get marginally worse. The counterparty transactions were really non-existent. There was no trust. But after September 15th, it wasn't just that there was no trust. Assets were completely frozen in bankruptcy proceedings. Lehman's assets were frozen. Anybody having a relationship with them couldn't tap into their lines of credit. The entire system basically came to a screeching halt. It put any normal flow of investor demand and supply. In the case of hedge funds, for example, hedge funds getting redemptions couldn't redeem without selling. They sold anything they could in order to make the redemptions, and that imparted the downward pressure on stock prices. That's what has really hit households big time. Somebody asked me today, Bill Ameti, who I don't know if he's still here, Seton Hall grad, used to work with me at Nomura, said, how much longer am I going to work at Nomura? And I said, well, until last year, I thought I was going to be maybe 2 or 3 years. Now I'm thinking it's more like 20 or 30.
Well, welcome to the club, because GE stock today closed at $11 and change. So I think I'll be there for a long time, or a greeter at Walmart when I'm 80 years old. Next question, please.
Please state your name and affiliation.
I am John Dukic. I'm president of Frenchel Systems. We build trading and risk management software, actually right here in South Orange. My question is, I understand that there's this huge growth and we're printing money, right? And now there's this concept of, buy American, right? Now, is that really going to work in the type of economy that we're in now, where our exports and imports are dependent on monies flowing between the countries, and if we're buying American, is that not going to hurt some of the foreign economies so that they now can't buy our goods?
That's one of the more disturbing parts of the bill that was passed by Congress, is that and I haven't read the legislation, it's 1,000 pages long, but I've read about it, and some of the things I've read about it are very, very alarming. And those alarming things are that they include provisions that you must buy cement from U.S. cement manufacturers or whatever. And in all of you have Buy American biases in this legislation. Now, I would like to see, if the government's going to do these things, minimize its intervention, its micromanagement of the process. Let businesses decide the best way to get it done, the most efficient way of getting it done. That's to the taxpayers' long-run interest more than these Buy American policies. It reminds me of, we like to think that we learn from past mistakes. We don't seem to have learned as much from the Great Depression as I thought we had, because the two things that were done badly and that led to the Great Depression is that monetary policy screwed up. Now, I think we've learned that lesson. But we also passed protective tariffs, the Smoot-Hawley tariff, which prolonged the recession. And, you can read whatever history you want, but the fundamental reality is that the New Deal programs didn't bring us out of recession. World War II brought us out of recession. That we had a decade of wheel-spinning government intervention, none of which had a lasting beneficial effect on economic performance. And that would be the same case now. I'm very skeptical that the fiscal stimulus, even if a perfectly designed one, is going to have very much impact.
So, Chip, you were saying, that support community banks. You're talking your book, yeah. So would it follow then that you think we should keep our money within the United States?
Well, that's a lot different, I think. First of all, my answer to your question would be no. It doesn't work. It's a bad idea. The community banks, on the other hand, you can't automate service. How many like going through the telephone system and trying to get to an operator? Show me your hand how many like doing that, because you shouldn't probably be here. And what happens if you do business with a bank and they get bigger and bigger, they get trapped into legacy pricing structures, et cetera. If you have interest-bearing checking at Bank of America, you might get 10 basis points on it. And then you get charged a lot of fees. And you're supposed to feel good about that, but if they were structured differently, they could probably pay more for the deposits. There is a tremendous amount of intellectual capital that's becoming people that are becoming available in this environment, and they desperately want a chance to make something of their own. And it's in the financial services business, it's in any of these businesses. Big businesses are not necessarily better, because what happens is the growth hurdle to get to their objectives becomes unattainable. So the community banks can really serve their community because they'll know the people in them. They can inspire the people who work for those banks, and they can give them equity in the company, and they can get good growth, and it can be very solid growth, assuming the community's solid. There's some communities where it's going to be a problem, but it can be a very rewarding experience. And I can tell you, when I was a bank analyst, I covered a company that at that point was very successful called Fifth Third. And there were tellers and branch managers and secretaries that retired from Fifth Third by 2000, and they were millionaires because of all the stock they had that had compounded and had been put away. But the numbers for growth were sustainable, and they could offer good service, know their people, and they stayed within their bounds. And that's a big difference than say, okay, you got to buy this car because it has Made in America on it. And oh, by the way, you're going to pay that person a lot more. Anybody work in a factory here in the 70s? I did. You know where those jobs are being done now? They're being done by machines. And, they're gone. And the people were not encouraged to be productive. People in these banks will be.
By the way, I want to go back to I think I didn't finish answering a question because I was being cute. When we were talking, back in September, we started to hear about, the catastrophe on Wall Street had spread to Main Street, that Main Street businesses were not able to get credit. There simply is not much evidence that was the case. Bank lending, C&I loans from commercial banks to businesses, never stopped growing. It's still growing. The implosion that occurred that led the Fed to start buying commercial paper was all in the finance company sector. Non-finance commercial paper, which is how more increasingly mid to large businesses finance themselves rather than through bank borrowing, I think fell at the peak to trough decline was about $10 billion out of 290 or something like that. It's been fluctuating. It's not growing a lot, but it's not in free fall. It's not declining. And in fact, for the most part, I think it's up slightly from the low point of just after, late September, early October. So the reality is that businesses, Main Street businesses, that had been until September or so doing reasonably well in an economy that was struggling, were able to get credit. They still have some access to credit. Right now, the problem, though, is that their business models are collapsing because their demand is collapsing.
Next question, please.
Please state your name and affiliation.
My name is Vincenzo Capone. I am a former student here at this great business school. And you guys provide some excellent information going forward about a rescue and recovery type of plan that is to be implemented But what about for the jobs? Because I didn't hear too much mentioned about jobs. If the unemployment rates keep rising, graduate students or people that do graduate don't seem to find jobs or be able to get out there and get the money to spend and put it into the economy, where does the money come from to get everything together?
So when do we start adding jobs again?
Then you can just
Okay.
all over me, so. Where are you going to get the money? The government should give the money back to the people. They should let the private sector start growing again. Right now, transfer payments and government wages in aggregate equal over 55% of private wages. There seems to be a disconnect in the discourse that somehow we can grow without having the private sector grow. And we need to get back to understanding that you need private sector growth to support the public sector and all the other things we want to do. And we're getting away from that. Profits are not a dirty word, but we're treating it like they are. And so I think that's what you have to do.
Okay, I'm going to try to answer the question, when do we start getting job growth again? Job growth follows the recovery, it doesn't lead it. And we're going to continue to see falling employment probably for most of this year. The unemployment rate, in my current forecast, hits its quarterly peak in the fourth quarter this year at 9.6. Actually, I think it might hit 9.6 early next year rather than late this year. And it's likely to hit its peak 2 to 4 quarters after the trough in the economy. If the economy hits a bottom in, say, June, then, a year later we'll still have probably a rising unemployment rate. But your question leads me into another thing I wanted to impart tonight, and that is, just how is it that economies get out of this kind of vicious downward spiral? And the answer is actually arithmetic. It's when things get very close to the bottom, to de minimis levels, it doesn't take much to get growth going again. Once you've gotten rid of the excess inventory of houses, the excess inventory of cars, you don't even have to sell very many cars or houses to need new ones to be made. And then you start hiring workers to make those things. The excellent presentation on the auto industry today by the students, I think makes an interesting point. Yesterday we got car sales results for December, partly because of a big fall off in fleet sales. Fleet sales were down 80% at GM, for instance. Car sales were at 9.6 million annual rate, lowest since 1982, but the lowest per person, per driver, probably in the history of the automobile, at least since 1945. The thing is, that means that we've had 4 straight months with car sales averaging about 10 million units. To replace the existing stock of cars that's out there, I have a car that's falling apart thanks to a deer. It's still, I can't open the hood to change the oil, and when the oil needs to be changed, the car's dead.
What kind of car? An American car or foreign?
All my cars are Lexus. This was a 1990, one of the first sold in the country. And it's only got 90,000 miles, but it hit a deer. What can I say? Or a deer hit it. The point is that it's not going to, if car sales get back to the replacement rate, which is about 12 million annual rate, sometime this year, that's a 20-25% improvement in sales from where we are. Some of those workers that have been laid off have to go back to work. They'll have income. They'll start spending again. The economy starts to grow. That's how you get out of recession. You need to get rid of the excesses wherever they are, and we have plenty of them to get rid of, but we've made tremendous progress at that, and especially in the housing sector.
So a bit of an optimistic note out of Dave. I want to take note of that. On the flip side, though, Jamie Dimon has said repeatedly over the past few weeks, the head of J.P. Morgan Chase, of course, that they're preparing for possibly unemployment north of 10% in a worst-case scenario. Next question, please.
Here's one here.
Name and affiliation.
Jay Zolowitz, I'm finance and IT. I'm here. With the current economic crisis, not half of Wall Street, but a good part of it was laid off. There are many MBAs with 20 years of experience out there for the current class to go up and compete against. In addition to this, a lot of the students haven't really had a chance to build any sort of credit line or anything like that to allow us to develop our own business. What would be your suggestion for us to proceed?
I'll take that.
When you say proceed, what do you mean, to get a job?
Well, to get a job, to become good members of the economic environment.
Well, I have a almost 22-year-old son who's about to graduate from Amherst in June with a major in economics and political science. And he's wanted his whole life to work in this godforsaken industry I'm in. And I think he's going to try to do it. I hope he gets a job. I'm asking anybody who might know of one to let me know. But I think also he and everybody in the graduating class of 2009 across America need to broaden their horizons and look at the vast array of interesting businesses to jump into. And some of the most interesting are the smallest, not the big name companies. And they're out there, but they're hard to find. And they're not going to be interested in hiring a washed-up MBA who spent 20 years at Lehman Brothers. And actually, the guy at Lehman Brothers don't have pity on him. Nomura hired a whole bunch of them, and we're guaranteeing them 2007 bonuses. By the way, I was just told today that our bonuses are going to be non-existent. Partly because we're paying all those Lehman guys.
You're not getting any TARP money either.
And we're not getting any TARP money. Actually, maybe we are getting a TARP money, but it's the kind that you put over a field.
I would echo that. Actually, I have a daughter who's getting her MBA after spending 3 years in the workforce, and fortunately it's her first year, I would say, but she ended up getting a job when she out of college outside of New York. None of my 3 kids tried to follow us. My son's graduating this year and is probably going to try to teach. He majoring in Chinese and political economy. The idea of working for small businesses is a good one. There's opportunities there. You're going to get more thrown at you. I would also be geographically flexible. When I was looking for a job back in 1976, I wanted to go into banking. That's what my dad did. That's what I thought I wanted to do. And I ended up in Cleveland, Ohio, which probably most of you would go, ooh. And it was a great place to start, and it was a wonderful place to raise a family. And we still have friends there. But there's opportunities out there, but if you just say they exist with the Wall Street firms, there's going to be a new generation of Wall Street firms, and they're forming right now. We don't know who they are, but some of them are going to be the smaller businesses.
And I might add, we don't even know what their business model is going to look like. But it's not going to look like the one that's worked over the last several years. It will change, and it's going to be interesting and exciting, but I don't know what it's going to be.
And you guys know something that the old guys don't. Now, when I was strategist, I had all these, MBAs and stuff like that helping me out. They could do stuff with the computer, get data. They had insights and analysis that I just didn't have. I wasn't trained that way. And it made me better. It made the product a lot better. And they got a lot of experience too. So don't sell yourself short.
And to Chip's point, as Scott mentioned when he introduced me, you're looking at a guy who moved from LA to Great Falls, Montana to start his career. And when I was going to USC and my business school friends, it was all about Arthur Andersen. Arthur Andersen, Arthur Andersen. That was where everybody wanted to go and ended up going. Last question, Josh. So we got time for one more. Got a hand up over on the other side.
Name and affiliation. Oh.
Steve Jonathan, I was one of the presenters this afternoon at a workshop on foreign exchange risk management. So I have a question about that topic. As volatile and tumultuous as it's been the past couple of months, we haven't had anything like an old-fashioned dollar crisis. And I'd be curious to see what you guys think about how the dollar, which counterintuitively, as you obviously know, has strengthened the past 6 months, what it means over the next 6 to 12 months, and is there a risk of that, which would obviously present the Fed with enormous new challenges?
So what's the currency exchange rate telling us?
Well, I guess it depends on which one you're looking at. The Japanese are catatonic about the appreciation of the yen. And, you know, my approach to exchange rates has always been that it's really about relative economic performance. And an economy that's well managed, I don't mean that by the government, but doing well and performing well is more likely to have a relatively strong currency. It's hard to explain Japan's currency in that context. Mm-hmm. It's easier to explain the dollar vis-a-vis the euro in that context, because if the U.S. looks like it's in trouble, the UK and the European economies are as bad as the U.S., if not, in the case of UK, much, much worse off. And we're seeing that reflected in those currencies. So I think that my general approach to currencies is look at the likely current and prospective performances, relative performances of the economies, and that's where the currency plays would be. By that reckoning, I think the U.S. is better poised for recovering first. That makes it more likely that the dollar would outperform the European currencies, and I think it'll probably rise against the yen as well.
Yeah, and I guess I would just add, watch gold. It might give us some sense of just, in total, what the view of currencies is in general.
Gold, I mean, it's still, we didn't even get a chance to talk about it, but I mean, it seems like that's where everybody's going right now.
Well, the debts that the governments are building up and the low rates, et cetera, just the store of value that they might think they could have from gold, it has shot up in part because of that. But look, I would just concur with what Dave said in terms of relative economic strength. And I wanted to add one other thing about Europe. Many of the European banks are more levered than the U.S. banks. So that is something that came as a bit of a surprise to me.
And anecdotally, I know from having just covered the earnings in my sector of big pharma, they were already saying, they took a hit from Forex over the last year or so, and now it's starting to benefit many of their bottom lines. So thank you, everybody, for your attention, for your questions, and of course, thanks for all the insight and great answers from our two panelists tonight.
Well, it's a shame we have to end so early because I believe this panel can really go on for hours. But I know that a lot of you want to get up to the reception and some of you want to get home to watch the latest episode of Lost. There are so many people that I want to thank for tonight's colloquium. And when I do announce your name, I'm going to ask you please to stand up. First, let's give another round of applause to tonight's excellent panel. Mike Huckman, Chip Dixon, and Dave Ressler. Also, this year we expanded the colloquium to a full-day event. That included seminars throughout the university and in the trading room. So I'd like to thank Brian Reynolds and Scott Fullman of WJB Capital. Tony Dwyer of FTN Midwest Securities. Phil Roth of Miller Tabak. And Stephen Jonathan and Guy Perserchio. Of course, I'd also like to thank Seton Hall President Monsignor Sharon and Provost Gabriel Esteban for the continued support of the Stillman School of Business. I'd like to thank Dean Karen Boroff, whose leadership has guided us according to our motto, hazard set forward, in spite of hazard go forward, which is so true in today's economic environment. Furthermore, I'd like to thank the Dean's Office, Assistant Deans Leonimus, Joyce Strasser, and Kara Passaro, and the Stillman School Administrative Team, Teresa Dehan, Joanne DiStefano, and Carol Flynn for their tireless efforts. The Department of Finance, chaired by Eleanor Shu, was also instrumental in today's success, as were the student members of the Investment Club and Stillman Exchange. Thank you all. Thank you to the many alumni who came back to campus for this evening's event, as well as our Finance Advisory Board chaired by Professor Chris Kinslow, many of whom who are in attendance this evening and participated in the corporate mixer, which took place earlier. And thank you to all the corporations who participated in the event. I would like to thank the Honorable Tony Blair for being my warm-up act. Mr. Blair now joins Secretary Hillary Clinton and Teen Boone Pickens twice, who warmed up for me. I'd like to thank Ann Mayo, Sports Management Department Chair, and Rick Gentile, the Director of the Polling Center, and their team of students, Bob Graziano, Brian Nelson, and Pat Flower, for organizing the alumni call notification. And additional thanks to Rick Gentile, who supervised the production of the videos which you saw earlier. If I could give you another Emmy Award, I would. Away from Jubilee Hall, but part of the Stillman family, we also have to thank Pamela Dungy, Jill Matthews, and the Public Relations and Marketing Departments for all the graphic arts, web design, and media relations, as well as our TLTC team up in the booth and around campus, Paul Fisher, Eva Gale, and Mike Supius for their valuable contributions. I cannot express enough gratitude to Tanya Dixon and my colloquium organizer partner, Professor Elvin Riley, who's up in the rafters, I believe. Working side by side with me over the past 8 months as we prepared for this evening's event. Speaking for the three of us, we hope that we made this year's colloquium a rewarding experience for all of our students, faculty, alumni, and guests. I'm most grateful for their hard work and look forward to 2010. Finally, such an event would not be possible without the continued support of Jim and Judy O'Brien, whose generosity is an integral factor in the rise of the Stillman School of Business to a nationally ranked program. Now I'd like to officially conclude the 2009 colloquium and look forward to seeing all of you in February 2010. We now adjourn to the reception of the fourth floor atrium, and I ask anybody who participated as a speaker or panelist in the event, please join me upstage for some photographs. See you upstairs.